Hello everybody, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you're aware of all your risks prior to placing any trades. Also note that in this presentation, we will be using hypothetical computer simulated trades and their results. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance coach and success coach with Lock in Your Success LLC, where myself and my team of mentors are here to help you win in life and in trading as well. Now, before we get going, I'd like to give everybody my best wishes. I hope that you're all healthy and staying safe, and that those of you who are stuck at home are staying sane. And most of all in the presentation, hopefully you'll be able to provide you with a little bit of entertainment and some great information on what we call income trading. Now in a moment we're going to go over the winning trade, but before I do, I'd like to tell you what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to make money through the passage of time rather than depending solely on price movement. Meaning we can often make money in the markets whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they would be than if we were simply trying to take a directional shot at the market. Now, if you find yourself wanting more information as you're following along, please contact us at lockinyoursuccess.com or put a comment in the comments section on this video, and we'll make sure we get back to you as soon as I can. The winning trade we're looking at today is called the V32. It's a shorter term broken wing butterfly style strategy on the Russell 2000, and it's a strategy we track regularly in our options trading for income webinars on Monday mornings. It's a fairly simple strategy that's easy to manage and can be traded with as little as $3,500 per trade. The entry date of the trade varies in the official program, but in the options trading for income webinars that we hold and we cover this trade, the entry date is always 30 days to expiration to make the examples a little easier to follow. Now, the position size on this example is going to be a 10 lot or 10 contracts or 10 broken wing butterflies, however you want to look at it. And with 10 butterflies, we're going to have a planned capital of $35,000. We are going to have an exit loss trigger, or a maximum loss as some people call it, of $2,500. And this trading strategy in itself does not have a profit target. Now that doesn't mean it won't make sense to put a profit target in when the market's excessively choppy and so forth, but for this example we are not using any sort of a profit target. Even though the position has no profit target, on a typical win, it's going to be about 5% or so of our planned capital per month, with larger wins being in the 13-14% range. And so far this year, this position is up despite the big market crash. After this trade, it's up about 9% for the year. So let's take a look here. This is what our entry position looks like. It is 30 days to expiration. It's March 18th, 2020. And again, we're looking at our April 2020 expiration, so very recent trade. And we're going to enter a 60-40 broken wing butterfly, about 20 to 30 points behind the market. And let's see, the market price is 980. The short strikes, that being the case, come in at 960. So we sell 20 short strikes here. We go up 40 points, buy 10 long strikes at 1,000, and come down 60 points and buy 10 long strikes at 100. And this gives us an analytical graph that looks like this. Now, for those of you who haven't seen an analytical graph before, this is the asset price down along the bottom. This is the profit and loss in dollars up along the side here. We have a blue line that looks like a triangle, and that represents what the value of the position would be at expiration. And we have what we call a T+0 line, which is the projected value of the position as of today. And of course we can add extra lines in here. We can add a get two projection lines in, and now we have a T+0 line in the blue, and then slightly above it you see this is what we call a T+15 line, or what the position is projected to be for value in 15 days. And you can see that over time this does increase in value even if the asset price doesn't move. As we go through time, typically you're going to see this T+0 line starts to try and form the shape of our expiration line. And that's essentially how that works. So let's put this back to one line. We have a maximum loss of $2,500. If the market went straight down and we made no adjustments, this does have a downside adjustment strategy, but if the market went straight down, we have no adjustments. We would stop out here at probably about 896. We do have adjustment points when we pass the short strikes. The downside adjustment on this particular strategy does vary depending on how the butterfly is positioned. In other words, how big this back wing is versus the front wing. Right now we're at the beginning. It's pretty much always 60-40 unless we have a negative delta on entry, which we do not here. And then we narrow out this front wing as the trade goes along, and we narrow the back wing as well most of the time. So this is what we call a positive delta strategy. So delta being, here's what our delta number looks like right now. We're entering at a positive 25 delta. This number is going to vary depending on what the market conditions are doing and what the implied volatility is. Right now we have an extremely high implied volatility, meaning that we're much more positive delta than we normally would be on entry on this. But that also gives us better profits to make should the market go up and reverse and go higher here. Now to the downside, like I said, we'd be adjusting down when we exceed our short strikes here at 960. For upside adjustments, this is a positive delta trade, meaning that if the trade goes negative delta, we're going to make an upside adjustment to make it positive delta, and we're going to do that by rolling in the upper long strikes. And to keep our capital under control, we are also going to roll up the lower strikes. Now in the program, we can only let the front wing go so small, this is called the front wing here, the short one, before we have to do the back one. So we're not going to get anywhere near $35,000 in this position on this trade. A lot of times it's going to cost a lot more, but the implied volatility is high. Now this is a big down day in the market, and generally it's going to be most beneficial if you can enter this trade in a big down day. That just happens to be lucky timing. So here we are, it's 30 days to expiration. If we take a look at our price chart, you can see that the market's been down a lot, right? This is the coronavirus crash, as they say, and we're down here at 980. It's 30 days to expiration. It's time to enter. So we put this position on here, and let's see how this works out. Day one, 75-point up move in the Russell. We are up $1,760 right off the bat, which is very nice. We don't have anything to do here. So let's go to the following day. Pull back a little bit, 28 points. We are still positive delta. Everything looks good here. We're definitely above our maximum loss of a $2,500 drawdown. All right, we're pulling back again. And the market looks like it's maybe retesting the bottoms here. Remember, we have an adjustment point when the market gets to 960. If it gets there, we're going to be taking this position off, and we're rolling it further back here. And that didn't happen. Right? Go to the next day, and we're up like 81 points. Here we are up about $3,600. Everything's looking good. And that's 10% of our planned capital, by the way, right? Because this was a $35,000 planned capital trade. It's much higher percentage of what we actually have in the trade. We only have about 15,000 in the trade. So let's move forward here. Continues up. By the time we're on the 27th here, we're up about 3,900. Now, in most environments, when we get a big up move in this strategy, usually it's going to trigger some upside adjustments. And I would be rolling this, taking this here, these five of these 1,000s and rolling them back. But when implied volatility is very, very high, what tends to happen is your T+0 line will stay very, very flat, and it'll stop you or cause you not to make up adjustments. And the reason we like that is because most of the time when your implied volatility skew is very, very flat, then the market's very choppy and there's a lot of downside risk. And this will help prevent us for making up adjustments. In this case, it doesn't necessarily benefit us because the market does keep going up. But eventually, let's see here, 31st. Right, April 1st, we have this nice 85-point down move, not really a problem. Looking good here on the 2nd. Looking good on the 3rd. And here finally we get what we call a shift in the implied volatility skew curve. And what happens when that happens is you get a nice pop in the T+0 line and it turns this position negative delta. So you can see we're now minus 8 delta. We're up $5,400, which is nice. It is time to make an up adjustment at this point. So what we're going to do is we're going to move some of these 1000s to 990, and if we have to move too many of them, we're going to take some of the 900s and bring them to 910 to take capital out of the position. So let's see where this goes. That's what we did. We sold 1,990 verticals. We bought 10 900 910 verticals, and now we're in this position here. And our capital in the position remains the same. And this is what we look like here on our expiration line. Now, would it be a bad idea just to exit here? No, it wouldn't be a bad idea at all. But like I said, in the strategy itself, within the guidelines, we do not have a profit target, so we're going to hang in here and we'll play out the rest of the trade. If we go one more day, we start, even though we get a bit of a down move here, we go a little bit more negative delta again. So we're going to make an adjustment. Like I said, this is a positive delta trade. So we're going to take 5 of these and we're going to roll them back to 980. In addition to that, we took these 910s, we rolled them up to 920. At this point, we only have, about $9,000 left in the position, and we're up about $5,500. So we're looking good here. And we're 10 days to expiration. Following day, we get a 52-point up move, and we are once again negative delta right here. So what we're going to do is we're going to take 5 of these, we're going to roll them down to 980. This time we don't have to move the lower wing. Our total capital in the trade here is a little under $15,000 at this point, and this is what our new position looks like here. And then if we go to Thursday, no changes. Let's go to Monday morning. Right, get a down move, but everything's fine. All the Greeks are fine. Everything's okay. Tuesday, we're up 23 points. Wednesday, we are up. The market's come down 48 points. And we are negative delta here. So we could make another up adjustment here. But if we do make another up adjustment, I also have to roll the bottoms up. And if you look at these, there really is no time premium in these options. They're pretty much all worthless, right? This has 27 cents, this has 15 cents, this one has 2 cents, 2 cents. They're all pretty much worthless. So generally what I'm going to do with this trade is probably just leave it alone and expire it. Or if I get a down move and we get up into this range here and these options actually gain some money in the next couple days, then possibly we can take it off there. What ended up happening is the following day, let me take this off. The following day, or today, the market came back down a little bit further, and now this is showing us up 89.92. Now, what I actually ended up doing here is, this is today, by the way, this is today. I ended up pulling this position off. I pulled it off at a small profit. It was like in the $7,000 range or something like that. So fantastic, fantastic returns on this V32. It was a nice, simple, nice, easy trade. And the total came out to be a 17% gain in 29 days. And that was the V32, this episode's winning trade. If you like what you see here, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options for Trading for Income webinars, and where you can also learn about upcoming winning trade presentations and our Trading Success Blueprint. And perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Please leave a comment on the video below. We would also encourage you to come over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as other fantastic bonus information on how to profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I'll personally answer any questions you may have. Thank you, and we'll see you on the next Winning Trade.